Good day, everybody. Chris Herline here of REAP Financial coming to you with this week's Wealth Report. It's already October 4th, 2024, and it's true, tax day may still be months away, but there are a lot of actions that you could consider taking before that tax deadline to help manage and potentially even reduce your tax bill. A lot of these tips I'm going to cover today can help you potentially save taxes here in 2024 and potentially help you save taxes 10 and 20 years from now. So let's dive in today to the top year-end 2024 tax tips that we are helping you and so many of our beloved clients consult through before December 31st. The first one I always like to start with is to ensure that you take your required minimum distributions. So this applies to all of you that are age 73 or older. You generally must take a minimum distribution from your IRAs before the end of the year. And if you miss this deadline, you can be subject to what's one of the highest penalties in the tax code. It's a 25% penalty on the portion of the RMD you fail to withdraw. Now, for many of you that we manage all of your IRAs, we will be helping you administer your RMD, take that thing before the end of the year. You generally are hearing from our team around November so that we can get that process for you. If you have IRAs, 401ks, or things that are subject to RMDs outside of our scope, make sure that you ensure that you calculate the RMDs correctly. So RMDs are a big kicker that we've talked about for many years, but it's one of those things that can be easily overlooked, particularly in your first birthday, that you qualify for that RMD age, which under today's law is now 73. For those of you that are over 70 and a half, you may have been taking your RMDs already and it's kind of on autopilot, but I like to always start with that one. Now, another one to consider is contributing to your 401ks. We're in October here, we're in Q4, hard to believe, of 2024, and if you've got some discretionary income, maybe you go and look at the 401k and you go, I'm not maxing out. This would be a good time to work with HR, your 401k team, and try to maximize those contributions. If you want to maximize, keep in mind it's pretty generous. Here in 2024, the max contribution limit for all of you that are under 50 is $23,000. If you're over 50, it's $30,500. So that's a big jump. They call it a catch-up contribution. Now, if you have a Roth 401k option, just keep in mind that you have the ability to contribute to both of those accounts. It doesn't have to be all or nothing. However, the amount that you can contribute still is limited to the $23,000 under 50, or if you're over 50, the $30,500. But you could do 50% to the traditional, 50% to the Roth. Now, remember, the traditional portion of your 401k is going to help you save taxes today because it reduces the income you're going to show on the 1040. But the money you put into the Roth 401k, although it's not tax deductible today, it will forever grow tax-free. It'll never be subject to RMDs. And for many of our clients like you, it'll probably help you save in taxes down the road 5, 10, 20 years out. Because like I said, when you go to live on the Roth 401k or Roth IRAs, it will never be taxed as income. You're in total control of the money. Now, that's a contribution that I'm talking about to the 401k and to the Roth. For many of you, you may be considering right now a Roth conversion. So there's two different things we talk about. There's Roth contributions, that's new dollars going in, and then conversions. Conversions allow you to take money that's already in your IRAs or potentially your traditional 401ks and convert it in the same year. Now, the approach to this needs to be taken cautiously because every dollar that you convert counts as income. For many of our clients right now, we're running these Roth estimates for you, and we come back and we say, hey, here's a few options. Option A, we convert a small amount. Option B, option C, you're converting a large amount. But the typical approach, a sensible approach, is to maybe just look at your income for the year and potentially convert enough just to stay in the same tax bracket. I'll give you an example. If you're a married couple this year and you're making, let's say, a combined income of $190,750, so a little over $190,000, you're going to be in a 24% tax bracket. But the limit to stay in that 24% is $364,000 and change. So the point of this is, if you're going to be in a 24%, maybe consider maxing out your current bracket. And that's true if you're in a 12, a 22, or a 24. But in the example I just gave, you could convert well over $100,000, literally over $150,000 in this example, and stay in the 24% bracket. Now, that's an extreme case because that's a large number, but it's all about maybe just simply maxing out your bracket and slowly getting your IRA dollars or 401k dollars converted to Roth. Now, obviously, when you retire, that's typically when we want to get the heavy lifting of the conversions done, because you may be in a lower tax bracket. But consider maxing out 401ks, consider taking advantage of Roth conversions. Both of these things have to be done by December 31st of each year. Now, another thing I want you to consider here is maximizing all of your other tax-deferred savings accounts. So if you've got an IRA outside of your company 401k, you can do up to $7,000 a year. If you're under 50, over 50, $8,000. And that, for most of you, will be a tax-deductible contribution. If you make over a certain income limit, you can still contribute, but if you're a high income earner, it phases out. You may not get a tax deduction, but again, it can, for most of you, provide some sort of tax savings. Also, you've heard me talk about it for years, is the health savings accounts. If you have a high deductible health insurance plan, maybe through work, you're not on Medicare A, B, or D, you can qualify for a health savings account, HSA. You can do up to $4,150 if you're a single filer or have a single plan, better said. And then if you're over 55 and married, you can do up to $9,300 in this thing. So quite a bit of contribution levels, and that can provide a nice tax savings. Also, you may have a flexible savings account, an FSA. That's a little bit different, but that can also provide some tax savings there. I also want you to consider what we call charitable donations, and there's two ways. In general, you can deduct cash donations to qualified charities worth up to 60% of your AGI, your adjusted gross income. And the other thing is you may want to consider donating stocks to charities of your choice. So charitable deductions can be a nice way to get some tax benefit. If you are charitably inclined and you're potentially going to, fund charities for a long time, I talked at the top of our wealth report here about required minimum distributions. A lot of our clients, a lot of you may not want to take the required minimum distribution, but you're forced to, right? And it can kind of be a thorn in your side. If you're over 70 and a half, you can actually donate all or a portion of your required minimum distribution to a charity or multiple charities up to your of your choice. And I'll tell you what, the limits are incredibly high. You can literally donate your RMD up to $105,000. Could be used as what's called a qualified charitable distribution, and whatever you give of that satisfies all or part of your RMD on the year without adding to your taxable income. Here's the problem we see with a lot of investors. They're over 70 and a half. They take the required minimum distribution. They pay tax. Maybe they withhold tax when they take the distribution, right? They put the money in the bank, and then in a year they give to charities of their choice. Well, you've now taken a taxable distribution in this scenario, and then you're going to get a small tax deduction. What we're talking about here is dollar for dollar. So let me just give you an example. If you had a $20,000 required minimum distribution and you took all of that, that's $20,000 of reportable income. But let's say you and your spouse, you give $10,000 charitably every year. So you take $10,000 of it as a direct distribution to you. $10,000 is sent directly from your custodian to a qualified charity or multiple charities of $10,000. Now you've reduced your required distribution reportable income by 10 grand. Okay, so the 20,000, now you're only reporting 10. So it can be a powerful play. It's better than a charitable deduction because, again, you're shaving income off the bottom line. Okay, so we like that. Also, when you think about your brokerage, your stock portfolio, maybe you have some dogs in there. Maybe you've got some capital gains from the sale of a house. Maybe you've exercised company stock. If you've got capital gains, okay, not income, but capital gains, or let's say ordinary dividends, which are taxed at ordinary income rates, you may want to consider harvesting some losses. So if you got some dogs in the portfolio, maybe potentially you can sell those for a capital loss, deduct that against your capital gains on the year, and if you don't use it all, you can carry those losses forward and deduct up to $3,000 a year under today's law. So take a look at your brokerage portfolio. That may be an easy way to shave some of the capital gains down. Now, the last thing I want you to consider is contributing to a Roth IRA. We talk about it all the time. It's one of the most powerful accounts. Remember, if you contribute to a Roth IRA, you're not going to get a tax deduction, but it will forever grow tax-free. And the thing about contributing is they have these income limits. So if you're a higher earner, let's say that your income exceeds $146,000 as an individual filer. If you're married, your income exceeds $230,000. You can no longer do what's called a Roth contribution. There is something called a backdoor Roth IRA. So if you're a high earner, that's one way that you can consider getting money into a Roth in a given year, even if you're over the income limits. But I want you to consult with a CPA or your advisor before taking advantage of that, because again, it can create some taxes. So just be aware of that. And a final idea is, many of you've got a nice portfolio. You want to help your family along the way. Maybe you've decided, we're going to leave some money to the kids, or maybe it's inevitable that you're going to leave money to the family someday. Just keep in mind that you can give away up to $18,000 this year here in 2024. That limit is now $18,000 per person to an unlimited number of people without it eating into your lifetime estate and gift tax exemption. So if you keep the gift $18,000 or less per person, so let's say you're married, you and your spouse could each give $18,000 to your son or daughter in this case, and that they could receive literally up to $36,000. If you keep it right at that limit, you don't have to file a 709 gift tax return, and it doesn't go against your limit. So maybe consider some gifts. I know you don't get any tax deduction for giving to the kids. I understand that, but it's a nice way to help them along the way if that's a value of yours. A wonderful way to see what kind of steward they are of the money that's been given, right? And that can often dictate your trust and how the money's left. So the reason we come to you every couple of weeks with these wealth reports is so that you can stay on top of things. And as always, I like to talk about our year-end tax tips here in October because it gives you plenty of time to consult with your advisor, consult with our team to see if there's anything else we can do to better your tax situation this year or in years to come. As always, never hesitate to reach out to us if we can be of service. We always appreciate your confidence in what we are doing for you and your family. And until we talk again, all the best.